Ultra high net worth individuals, how do they budget?
Budgeting is not actually a tool of the wealthy.
So it's not a one size fits all.
Personal finance is meant to be personal.
What do you mean by automate savings?
In the future, their dollar won't go as far.
Because right now, most people, our investments are automated.
Wealth isn't built through reduction. Wealth is built through value creation.
That's not an investment, that's savings.
People say they're saving in their 401k. You're not saving.
It can be helpful to a point.
You don't want to be in a lower tax bracket.
How can I implement some of the same stuff without millions of dollars for a command center?
If you're just starting out, investing isn't the right game. Investing in skills is the right game.
A number of ultra high net worth individuals.
Yes.
How do they budget?
All right. So first, let me lay some context here.
Okay.
Personal finance is meant to be personal.
Okay.
So as I, unveil perspectives and ideas, I want people to say, how does it apply to them?
Gotcha.
What works for them? What stage in life are they in?
So it's not a one size fits all.
Right. Like, look, budgeting is really important when people are spending too much and they're going into debt.
Mm-hmm.
It's a really instrumental tool, but budgeting is not actually a tool of the wealthy.
Okay. But we know that they don't just like spend haphazardly.
Right. They're going to forecast.
Okay.
They're going to create a command center.
Oh.
And this command center, they are going to have they're going to automatically create liquidity, which everyone could benefit from automatic savings.
Mm.
But they're going to be really deliberate with how they invest. And unfortunately, we've kind of collapsed these two words, savings and investing.
Okay.
Right? People say they're saving in their 401k. You're not saving. You're automatically investing.
Okay.
And that automation, great, it gets you to do something, but it doesn't measure outcomes. It doesn't create cash flow. It might not be the right priority. It might be that there might be people that right now have 20 to 30% credit cards, right? Investing is not really the highest priority in that place.
Oh, because
it's hard to get a 20 to 30% rate of return.
Gotcha. So
and if you can pay these credit cards down, that's 20 to 30% savings. So automatically maximizing retirement plan wouldn't be in this person's best interest.
Okay.
Because they have high interest rate credit cards that are a guaranteed cost versus a non-guaranteed investment. Now, I know some people are going to say, I work with entrepreneurs, but there's a lot of people that are employees. They say, yeah, but I get 100% match. And that's 100% return. Well, okay, for that first year it is, but the next year it's not, because it's, that money's just in there and it's now earning, hopefully growing over time, but you're not getting a match on every single existing return. To get 100%, you need 100% every single year on the existing old money, not just the new deposit. Now, it will impact it, it'll grow it, but not as much as most people think. So, yeah, that's great, but there's also these conditions, right? There might be vesting period, right? Before that match is officially theirs.
Yeah.
It's in investments that can be volatile, right? And those are going up over time, but they also go up and down in the short term, right?
Yeah. And don't they also have stipulations where it's like if you leave the company?
Yeah, that's the vesting.
Oh, gotcha. Okay.
Maybe it's 5 years, right?
Wow.
Before it's vested.
Yeah.
And maybe there's a certain percentage vested in the first year, second year, third year, fourth year, and then fifth year. Now it's fully vested because it's kind of a golden handcuff for some people.
Yeah. Yeah.
Right. And so
then when you get a crappy manager that you hate, you're stuck there. Right.
Right.
The person
Like,
that you're
okay,
actually
now
working
you're
under.
stuck there because I want to get that match. I want to have that become mine. Well, again, if you have really high interest rate credit cards, and the other issue is maybe the best thing you could do is grow a skill. Charlie Munger said famously, he was like, hey, if you're just starting out, like investing isn't the right game. Investing in skills is the right game. So you could increase your income, so you could increase your value. And so, yeah, again, there's the people out there that are proponents of budgeting, but budgeting is very restrictive. I kind of think of it like a diet.
Okay.
Right. Which the first three letters is die in diet. And it's all restriction. And that's fine. Reduction could be a strategy for a time, but no one shrinks their way to wealth.
Okay.
You don't shrink your way to wealth. That's just not how it works.
So you think it can be helpful to a point?
To a point. But I'll give them, the way that I look at it is mindful cash management. So the first step in that is, yes, to automate, right? Automate. And what you do is you want to have separate accounts. You might have your regular checking account, but then you'd have what I would call like a wealth capture account, like a separate account. So you could automatically take a percentage off the top before any other dollars go anywhere else. So you're paying yourself first. And that's going to help you build liquidity, right? You want liquidity.
But that's not an investment. That's savings.
That's savings.
Okay.
And so it's different than investing.
Because right now, most people, like, our investments are automated.
Right. Investments are automated with penalties if they want to get to it, deferring their taxes, which, you know, I really have angst with this notion of people being in a lower tax bracket in the future. You don't want to be in a lower tax bracket. You know, we were talking on the drive up here about, you know, where I live, they want to raise property taxes by 20%.
Jeez.
And there's a lot of people that are showing up to the, you know, town hall and the town meetings and saying, hey, I can't afford that. I'm on a fixed income. I'm retired. If you increase that, I won't be able to afford my house, because they had a couple issues. We had this huge rise in housing because we had really low interest rates. And most people are buying based upon the payment, not based upon the actual price, right? Yeah. It's payment. They're like, how much can I afford? And that payment starts to go up with increased taxes. And so if someone's living on a fixed income and they didn't think about it, they thought, yeah, I'm just going to pay off my home, which is great. You know, if you pay off your mortgage, that's awesome. I'm not saying that, like, I'm not here to say you should always have a mortgage or never have a mortgage. I choose to have a mortgage because it's at 2.75% and I can do better than 2.75% very safely and confidently, because that's who I am. That's what I know. But others, maybe they would just spend or blow that money. And so maybe that's a better thing for them, but they have to consider in the future, their dollar won't go as far. It's losing half of its value every decade, essentially.
Yeah, and it's also interesting because, like, in that equation, people don't talk about, even though your mortgage may be paid off, you still have property taxes.
Still property taxes, still have insurance.
Yeah.
You still have, you know, and insurance costs have gone up quite a bit over the years.
Yeah, substantially.
Right? So you might have this amazing home that starts to be a strain, even though it's paid off, because now you're trying to live off your retirement plan, which, if the market isn't cooperating at certain times of retirement, maybe it has a down year, or maybe you can't get enough fixed income with something safe to kick off enough interest to, you know, live the way you want, because you're going, oh, I've been told to, you know, never touch my principal, only live off the interest. Well, inflation starts to eat at that every single year. It's a stealth tax, because you're not sending money. You're not giving that money to the government. It's just your purchasing power is being reduced. It doesn't buy as much. That dollar gets half the groceries that it used to. That dollar gets half the gas that it used to. That's very simple as we talk about it. But when people think, okay, I'm just going to pay off this mortgage and then I'm going to put all my money in a retirement plan, and they call that savings. But then along the way, right, whatever that path is, along the way, if there's some type of surprise, there's, you know, a career change, there's a cash flow crunch, there's a health challenge, there's a whatever it might be, if everything's locked away, now there's a penalty to get to that, and there's taxes to get to that, because it was all trapped inside of a plan without enough savings. For me, it's a 6-month minimum that you want to have in some type of savings. Now, that savings, that could be in some silver, that could be in some gold, that could be in cash value. Not everybody likes life insurance, but I use paid up additions and have really good cash value that's, you know, got 4 or 5% after costs.
Gotcha. But so you're saying that's still considered to you a savings. It's not an investment.
These are savings.
Interesting.
Right? It's not like they're creating cash flow.
Yeah. Because I feel like a lot of people compare the cash value to like a 401k, but you're talking about them
totally
as completely
different things.
Like,
I compare my cash value to savings, and it's doing much better.
Yeah, gotcha.
And it's giving me multiple benefits because it's got these tax advantages, right? I can put money in, and the money I take back out is FIFO, first in, first out, meaning I get to pull it back out tax-free before I get to my interest or my dividends.
Oh, okay.
I can also take loans. And those loans are private loans. It doesn't impact my credit. It doesn't matter what my credit score is, but I could borrow and pay it back on my choosing and when I want. If I don't, it subtracts from the death benefit. So that can also be part of the tax advantage. But B, there's also some benefits. I have a death benefit, right? And the first thing I like about it, it's a permanent death benefit, meaning it's going to be around one day longer than me. where term insurance only pays out 1.1% of the time. So if I'm putting money into term insurance and savings earns a lower rate than cash value long-term. As a matter of fact, I look at this as like what I would call, you hear people say asset allocation. So how are you allocating your money, right? And the asset allocation is basically, I'm doing this instead of bonds. I'm doing this instead of money markets. I'm doing this instead of savings. So in any 30-year period of time, there are 7 companies that have always beat these things, right? They're mutual, companies, mutual instead of stock. So they pay dividends to the policyholder, not to the stockholder and the policyholder. And they've been around for at least 100 years. They've always paid dividends. Dividends are not guaranteed until paid. When they're paid, they become guaranteed. But there's a minimum interest rate that you get, which is, competitive with the savings account, essentially.
Okay.
So I like having cash value, because now I have that permanent death benefit, and I also can put provisions on there. They do cost money.
Yeah.
Some of them, like there's one called waiver premium. It says, hey, if I'm disabled for 6 months, they'll keep paying the premium for me. That's waiver premium. So that gives me like a self-completing plan if something goes not according to like what I expect. There's free things in here, like accelerated benefit rider that says, hey, if I qualify for 2 activities of daily living, that is like of the 6 main ones. So 2 of the 6 means I can spend up to 70% of my death benefit while I'm alive. So let's say I can't feed myself, or I can't dress myself or bathe myself, like, what qualifies for people with long-term care. So all of a sudden I'm getting more advantages to my cash.
Off of that. Gotcha.
But I'm not comparing it to a 401k. A 401k, the stock market, an index fund has outperformed cash value over long periods of time, over and over and over again.
But they're different vehicles in your.
But they're also, there's tax implications that we have to consider and things like that. It's just, I'm talking about savings. I'm talking about my 6 months.
What are some other savings vehicles that you
I really like silver, gold, and cash value are the top 3.
Oh, okay.
There's, maybe you can consider Bitcoin at a percentage, but it's volatile, right? It goes up and down. So maybe 50 cents on the dollar could be towards that 6 months, because I could borrow against, at 50%, not have to pay taxes. But I also recognize, because it's more volatile, it's not really savings. It has more of an investing component than it has a savings component. But I can consider that when I get to the 12-month mark. Maybe I'm going to use some of that with Bitcoin.
Gotcha. Right? So then going back to the billionaires, how they budget.
Right.
So you talked about a command center. Like, what does that actually mean?
Yeah, they want to look at their cash flow. And the first thing they want to do is they want to be efficient with that. So they're really good at like saving tax, where a lot of people that are kind of stuck in this middle-class mindset, it's more deferring tax, not saving tax. So people think, oh, well, look, I paid less tax. Let's say let's just use 10,000. It's an easy number. They put $10,000 into their 401k. The 401k is going to show a $10,000 balance. What's underneath that? The reality is some of that money's yours. Some of that's just deferred to the government.
Right? Oh, gotcha.
So if you're in a 30% tax bracket, as an example, really 7,000 is yours. 3,000 is the government. So if it grows, let's say it grows to $20,000, right? You're like, awesome. It just grew. Well, the reality is 14,000 of that is yours. And 6,000 is the government's.
Yeah.
It grew at the same rate for both. So there's not like some magic trick, but they say, oh, you'll be in a lower tax bracket in the future. Well, here's the first issue that is a concern with the lower tax bracket, okay? Is inflation means we have to have, in a 10-year period of time, twice as much money.
But the tax brackets would adjust with that.
Right. You'd actually have to pay more tax because you'd have more money.
Okay.
Not more purchasing power. So if you're single, your first $11,925 is taxed at 10%. That's nice. If you're married and you file jointly, it's $23,850.
And that's for everyone. So even someone, with billions of dollars, they're first.
They just get there really fast, right?
Okay. Yeah.
They're past that first bracket because they're earning money faster. They have more money.
Yeah.
But then it goes to 12% from $11,926 to $48,475 for single, or up to $96,950 if you're filing jointly. Then it goes to 20. But here's the thing. As you make more money, they don't go to the previous dollars and tax them higher. No matter who you are, it's always taxed at that lower rate. It's just in that corridor. Then it goes up to 37% when you're over $751,600. $600. Okay. So let's say that 10 years from now, you have twice the money and the tax brackets are the same. Well, look, you're actually paying a higher tax. So you have less that comes into your pocket, even though the purchasing power is less, right? So if you have to have $200,000 to have it spend like $100,000, at $200,000, you're at a 24% tax bracket instead of 22%.
Yeah, but presumably wouldn't the tax bracket adjust a little bit, in 2030 or something like that?
I mean, they adjust these all the time.
Oh, okay.
And like, look, when I was in college, it was 15% if you're over $23,999. Right. So yeah, it's adjusted a little bit, and we've had taxes get lowered. So you see that, but we also have $38 trillion in debt.
Yeah.
So it could go up because from 1944 to 1981, the top tax bracket was over 50%.
Oh, gotcha.
Now,
okay. So it's not reliable is what you're saying. You don't know what the tax bracket will be.
It changes. Like estate taxes are all over the place. There was a year where there was no estate tax. The year George Steinbrenner died. That was a very Yankee thing of him to do, to die and then be able to pass all that money tax free. Right. But then there's another time in my career where it was 625,000. When we were above 625,000, you get hit with the state tax. So that's changed. It's like 15 million now. But
yeah. So the idea is like with the 401k deferring your taxes, you're deferring to an unknown because you have no control over what the government will decide on taxes at the year that you decide to retire.
Right. And part of the reason that your house goes up in value is inflation. Right. It's not that the house, from a tax perspective, when people invest in real estate, they get something called depreciation for tax purposes. Right. And it's saying, hey, things wear out. You have to replace it. You have to paint. You have to change the carpet. You have to, there's things that get fixed up. So for tax purposes, it's going down. But in value, if you want to sell it, typically over long periods of time, right, it goes up and down, just like a market goes up and down. Well, the value could go up. Let's say it appreciates at 3% or it appreciates at 6%. Depends on the time, right? Well, now your property tax naturally goes up because your home is worth more. But they might also increase property taxes, like in Salt Lake, where they're talking about doing a 20% increase, which is really bad for people who didn't plan properly. And they might have been really good budgeters. They may have paid off the mortgage. They may have a bunch of money sitting inside of the retirement plan. But if that retirement plan, let's even say they're a millionaire, they have $1 million. How much money can they safely take out of that without risking that $1 million going down? There's a thing called the 4% rule. Says if you take more than 4% out of an account that's going up and down, the problem is if you take money out when it's down, you start to decrease the value. So if you have that million, right, and it just so happens the first year you retire that the market goes down 10%, now you're at 900,000. But what if you planned on taking out 60,000? So now you've taken out 60,000, right? Wouldn't be exactly this because it was over the year, but you might be as little as $840,000. Now the market goes back up 10%. You're only going to gain 84,000 in 10%. You're not gaining the 100,000 before when you took it out. So we see with investing, the market goes kind of up over time. Disinvesting is the opposite curve. It goes down over time as you start to pull money out. And that's one of the risks that people face. So what if property taxes go up and inflation's a little bit higher at a time when you start to see downturn. Now, most of the time, inflation has been pushing the market up. Inflation has been pushing the asset values up, which is really a problem for people that are just, on a fixed wage, because wages have gone up at about 2 times the rate where, real estate's gone up about 6 times the rate.
Yeah. Well, and that's interesting.
That's a huge gap, right?
That's interesting that in the kind of command center philosophy, a part of the quote unquote budgeting is to save on tax. Cause I feel like that's never really something that you hear, Dave Ramsey or Susie Orman talk about.
Right.
Yeah. It's like saving on tax is never included in your traditional budgeting terminology.
And some people say, well, you can do a Roth, and that's right. If you qualify to do a Roth, or you can even, no matter how much money you have, there's something called a backdoor Roth where you can convert later on from a traditional, but you have to pay the tax on the conversion. Right. And if you pay it from the account, there could still be penalties. You have to pay it from your own cash. And that might be smart during a year where you have less income. That's called like income, diversification or distribution diversification. So, yeah, that's right. You could do a Roth but some people are going, no, if I do a traditional IRA, I'm going to put that money in pre-tax. I'll have more money growing, right?
Yeah.
So yeah, we go back to what I said before. Well, if you start at 10,000 and that grows to 20,000, well, guess what? If your tax bracket's equal, the government is still taking their 30% of that.
Same percentage.
Right.
Yeah.
So you're still going to end up with 14,000 here or 7,000 here, unless you do this before 59 and a half. If it's before 59 and a half, you actually have a 10% penalty. So you end up with 6,000. Right.
Yeah.
Or you have another, over here, you have another $2,000 penalty. Right. So you only have 12,000. So you're at a disadvantage before retirement age.
Yeah.
And in a Roth, let's say if taxes stayed equal, taxes didn't change, you're in a 30% here or a 30% in the future. Well, guess what? Whether you do a Roth, and maybe in a Roth, you end up with, we'll use small numbers here again. Maybe inside that Roth, because you had to pay taxes up front, you only invested $7,000 because you paid the $3,000 up front. So that $7,000 when it doubles is $14,000. Where if you're in a traditional, it was pre-tax, right? So you're like, awesome, it's pre-tax. That means that I had the full $10,000 at work, and now I have $20,000. So here's one advantage: if you're living off your interest, this interest will be tax-free. This interest will be taxable. So yes, you could take out more. So if taxes decreased, the traditional IRA is a better deal because now you have $20,000, and if now you're at a 20% rate, you end up with 10% more money, right? Okay. So you, instead of ending up with $14,000, you're going to end up with $16,000 if you cash it out at a lower tax rate. But that's a big if. Now people argue and say, well, look, I don't need as much money in retirement because I won't be paying for my kids' education. I won't have to be saving for retirement anymore. Okay. Again, we have to just consider what is going to be the impact of inflation. What is the impacts of tax, fluctuations? Here's other things. What about just technological change? Yeah. What if you're buying things you didn't even know existed that you're now like
that you're not accommodating
computers came out, they didn't exist, and now pretty much everybody has one. When cell phones came out, nobody knew they existed. Now pretty much everyone has them.
Well, it's like AI subscriptions are like a expense that I never thought about before. Yeah. It's like now it's like
pay for cable. Now you got 7 apps that you have to pay for. Yeah. So we also have a thing called planned obsolescence. And what that means is things break and have to be fixed. They have to be repaired. Just like I said, with depreciation on real estate, you have to change out the carpet. You have to repaint, stuff like that. There's a new dishwasher that needs to be put in, whatever it might be. Like we have to put in a new air conditioner. We have 2 of them. One of them went out. So, when summer comes, we'll put in a new air conditioner. So that's planned obsolescence. So there's inflation, there's tax, there's technological change, planned obsolescence. And here's the thing that really matters to me is this quality of life factor. Some people might call it propensity to consume. Like when I think about how my wife and I used to go out to eat, and I remember I went to dinner with her cousin and he was making fun of Applebee's. I was like, man, I love that Santa Fe chicken salad and lime chicken. And he's like, dude, it's gross. And then all of a sudden we started eating at nicer restaurants, and I was like, it kind of didn't taste the same.
Oh, gotcha.
And I didn't ever fly first class in my 20s. And then I started flying first class. I'm like, I'm a big guy. It's like, that's a luxury once enjoyed becomes a necessity. Yeah. Right. Once you're like, oh, it's hard to go back. Yeah. So all these factors really impact inflation in the future or our purchasing power with our money. And if we're too one-dimensional, it's just, hey, a budget is going to be limited. How it's limited is it's all about what you can save, what you can reduce. But again, wealth isn't built through reduction. Wealth is built through value creation. That's why the command center is so important, because they want cash flow reports, right? They want to see how everything's working, how it's owned. They have this philosophy, own nothing, control everything. So they own it in trust. And that could even be very tax efficient. It may allow them to, put more money to the next generation without tax implications by having the right trust. It might protect their assets from other people because there's financial predators that are coming after them. As you get wealthier, that tends to happen. And so what they're looking at is, how do I effectively deploy capital? How do I become a good investor? And so in a command center, they're looking at how do I own it? How do I make it tax efficient? How do I improve cash flow? And how do I stay informed so I can manage and mitigate risk? When you put something deferred with tax, you have less ways to manage that risk because you don't control future tax rates. The government controls the future tax rates. A different party gets in, they change the taxes. Bigger issues that they're trying to deal with, they might raise the taxes. And again, that could be sales taxes, that could be excise tax, that could be property tax, that could be income tax is the big one that a lot of people focus on. So this command center philosophy is, yes, we want to know the flow of our money. We want to know where it's going.
Okay.
But we also want to say, how do we become an investor more than a saver? See, or some of the savers I would call speculators because they're just speculating on a market they don't control. They invest in things they know nothing about. They don't learn how to create cash flow. Where an investor says, well, if I can deploy $1 and make more than $1, that's a good investment. Where a saver says, I make an income and I'm going to save a percentage of that income. They usually say 10%, maybe 15%. And then I'm going to invest that to try to get 10%, over a 30-year period of time. And that whole time, inflation's kind of working against them. They're taking their most valuable dollars to pay off loans that become easier to pay as time goes on because income is going up. The loan stays fixed if it's not a variable interest rate. That's a hard thing for a lot of people to understand, is they have a hard time understanding that inflation is actually helpful when you borrow money. It's harmful when you don't have assets.
Gotcha.
See, like if I buy a piece of real estate and I get a loan. So let's just say I put 20% down to avoid PMI, private mortgage insurance. If you have 20% down, you don't get charged it. What private mortgage insurance is, hey, if I put less than 20% down, the mortgage company is saying, I want to charge a premium. I want to charge you an insurance in case you default. There's not enough equity there. So if I have to foreclose and sell this, I want money because there's more risk. You have more skin in the game with 20% down. But now if I finance the other 80%, I've created leverage. Now here's the thing. Most people are not good with leverage. So if you leverage money, you leverage money by borrowing, right? But you don't have the mental capital, which is the knowledge, the insights, you don't know what you're doing. You don't have the relationship capital, which is the right network or the right team, like you'd have in a command center with what's called a family office. Family office is what the wealthy have. And that family office, if they're wealthy enough, the ultra high net worth.
Like how wealthy?
Like if you had your own family office, you'd probably have to be around $300 million. But billionaires have family office. Like a billionaire is going to have their own tax team, right? That works just for their family. They're going to have their own attorneys, right? In-house. They look at how everything's owned, how everything's protected. They're going to have their own investment team, right? They're going to go to family office events where they learn from other family offices where they're investing and what's working. And they might invest in things together, right? And so they have this entire team that's working on their behalf.
So it's basically a business that works for your family, more or less.
And the command center is looking at their whole financial picture and saying, are we in a place where we are stable, where we're secure, and we can grow? And where most people are just taught, look, it's really complicated. Just pay off your mortgage, put your money in a retirement plan. And the problem is retirement plans, let's go through how retirement plans even came about. I mean, it used to be that we had pensions. And pensions, you'd work for a company, again, golden handcuffs. And it started with these companies, like the earliest that I've really read about it was in 1947, where GE wanted to dominate in every category they were in, but they were falling behind in a few categories. And they said, well, the only way we're going to do that is we're going to have to hire the executive from our competitors. How are they going to hire them? Right? How would they do that? Well, they're like, we're going to have to offer them something they don't currently have. And they said, if you come and work for us and help us, when you retire, we're going to pay for your retirement through a pension. And they did this through a pretty interesting way. They used something called non-qualified. Non-qualified means it's not like a 401k or an IRA or a government qualified plan. It's non-qualified. It's private, non-qualified, deferred compensation. You're not getting paid now. You're getting paid later.
Okay.
And the way that they would handle this is because they knew that the company was going to be around longer than the individual.
Okay.
Right? Like GE outlasted its executives.
Yeah.
So they immediately bought life insurance on the executive, right? They bought the life insurance policy, but they bought a permanent policy.
So how do you buy life insurance on someone who's not like your family member?
So one, this is critical. You have to have an insurable interest. Now, there's things that they were calling peasant policies. That was Walmart. When you signed your employment contract, you signed off that they could get insurance on you.
For all employees?
Yeah, for all employees. So,
Wow.
you know, and think about it. Greeters, do you think about them as young or old?
Older.
And so people are really frustrated. You just made money on grandpa's death, right? They were very frustrated about it, but they knew when that person died, the money would come in tax-free when they just lost that training and that person that was bringing value to the organization.
And so Walmart just had to show that if that person passed away, it would impact their business.
Yeah.
And that makes an insurable interest.
And so sometimes you hear this called key man, where like key man is like for partnership level and executive level key man policies. You know, if they die, it buys out their partnership. That money goes to their family. You know, there's different ones. There's like buy sell would be one. Hey, the death benefit's going to come in and buy out the shares and you sell the shares, right?
Okay.
Cross purchase, there's another kind. So there's different kinds here. And those are usually for key men, but they called it peasant because it's like they're just getting on everybody. And there's smaller death benefits because what is the real impact, right? That's the question.
Yeah, they're not getting millions of dollars per person.
And they're also looking at, could they get small amounts of insurance so they don't have to go through the whole bit? Like, are they insurable in the first place? Are they, you know, maybe a $30,000 policy, you don't have to get, you know, blood taken and look at all the analysis. You just look at their, you know, their medical history, but they have to sign off because there's, you know, the medical bureau and there's certain like HIPAA rules and stuff like that. So you have to sign off on it, but I can't just go buy insurance on anyone on the street because I don't have an insurable interest.
Gotcha.
But I can buy insurance on employees because if they die, there's an impact economically to the business. And so this was pretty smart that they went and bought these policies because what would happen is, over time, right, the cash value would kind of grow. They'd have a death benefit from day one, right? But that cash value would grow and they could use that to supplement the pension if they wanted, depending on how long these people would live.
And you're not talking about the peasant ones in this case. You're talking about
I'm talking
GE.
about like GE.
Okay.
And so they would use the cash value, right, to kind of pay for that if this was the retirement date right here. And then when the person would die, the death benefit would come back into the company tax-free to replenish what they had spent. So there's still a cost out of the pocket, opportunity cost, paying for the policy and things like that. But eventually you saw Wall Street came and said, this is crazy. Why would you try to get 5 to 6% when the market's going to do 12 to 15%? If you think back to the 90s, right? The 90s was this huge economic boom. The stock market's getting double-digit returns year in and year out. They're like, you do so much better. But guess what? When I said there's investing where it grows this way and disinvesting where when you start taking money out, well, they couldn't afford the pensions during down years. We had the year 2000, 2001, 2002, all negative years.
And would they just not pay them?
So they were paying them, but it was destroying the pension. And then what happened is they started to declare bankruptcy because of the pension, right? And there's a whole book on this by, I think, Michael Lewis, The Fate of the States, where there were certain states like California where there would be government employees, for example, that were offered pensions, right? And then what would happen is when they would finish work, they would leave California because it was expensive and go to a more rural place where it's more affordable. And places like Stockton, California went bankrupt because pensions had such a high priority that they would be paying for pensions but couldn't afford their police force anymore.
Jeez.
And they would only attend to something if it was a crime in progress. Otherwise, they didn't have the capacity because they had overextended, overcommitted because the market didn't always get the returns they anticipated. They sold certainty for risk. And see, billionaires they really focus on how do I create more certainty?
Okay.
Even though when people look at them, they go, oh, these people take so much risk. Well, they're willing to put capital in places that other people aren't. Right? We can look at the, Carnegie, right? With steel. We can look at Rockefeller with oil. And what happened is they saw something everybody else saw as risky and they made a ton of money by being able to allocate and put money towards that. And they were investors that grew and people thought, oh, that's so risky, but they saw things other people didn't see. So it wasn't as risky for them because of what they knew and how they could do this. So they weren't wealthy because they budgeted. you know, you can read books that say if you just, you know, cut out your latte, that you'll have more money in the future.
Yeah.
And look, if you're barely making ends meet, that's good advice.
Yeah.
You've got to live within your means, but there's 3 ways to live within your means. One is to budget, and budget will not make you a billionaire. It won't.
Gotcha.
It'll help you, you know, get to somewhere. You can budget and be really extreme, like in the Millionaire Next Door, where people just don't spend money and they save and they save and they save and they defer and they defer, and they can be $1 million on paper, but they're still kind of living like paupers in their life. They don't really have a high quality of life necessarily. The second thing is to be more efficient. And this is a huge part of having a command center, because you're going to look at the 4 I's to efficiency, which if you watch my videos before, these are the IRS. It's a huge place where people can save money.
Yeah.
Interest, right? There's a lot of people that, again, if they're paying really high interest rate credit cards versus when you have assets, for example, we work with a firm that if someone has assets with that firm, they can immediately get an 80% of that asset line of credit. Well, 80%. And because it's collateralized, it's a lower interest rate. I've had clients get up to like only 1.25% interest rate on that.
Really?
Right.
Jeez.
So because it's collateralized.
Yeah.
So it's a really good, you know, really good situation, which means now they're buying stuff at 1.25% and earning 5%. That's a huge
awesome
upside for them. Right. The next is investments. How can you get it where you don't have to pay so many hidden fees and commissions and all this kind of stuff? It's through investment savvy and understanding. I mean, an index fund after 20 years is going to outperform a managed fund 92% of the time. You know, there was an article they put out in the Motley Fool talking about that. In Investopedia, you could read about it. There's multiple citations towards that. And then even how you design insurance. A lot of people just insure inconsequential things, and those are expensive to insure, versus catastrophic things, which are less likely to happen, which gets you more bang for your buck. So efficiency with the 4 I's. And then this is the real game changer, expansion. That's the investor. How do I create more value? How do I serve more people? How do I solve bigger problems? How do I make greater impact? How do I reach more people? How do I more deeply impact the people I reach? That's the game. And so when all of a sudden you look at your money, not as something that you lock away that you have no understanding of, but you look at it as, first off, how can you create the cash flow that creates your foundational pieces, right? This is financial independence. Financial independence is when you have enough assets, creating cash flow to cover 100% of your expenses.
Yeah.
So now you're not covering your expenses through your active income, you're covering it through your portfolio income. And if you're trapping your money in a retirement plan, and you're also taking extra cash that you have to pay down an amortized mortgage. So this is the way an amortized mortgage works. When there's amortization, when you put extra money, let's say you put an extra $1,000 into that mortgage, it will shorten it. So if you had a 30-year mortgage, maybe it's going to take it down to 22 years, depending on how often you're putting that $1,000 in.
Okay. Yeah.
Right? And how much you've loaned. So it'll shorten it.
Yeah.
But it will not lower the payment.
Yeah, because it's amortized, so you're always going to have to pay the same.
So you're paying extra, and that's money. That money goes into what I call equity jail, because the only way you can get to that is refinancing, getting a line of credit, or selling the property. So you're actually trapping money away that's really valuable dollars today. What people don't think about, and this is really important to understand, is opportunity cost.
Yeah.
See, it's so easy for me to look and say, if I put money and I pay off a loan, I know exactly what interest is saved, right? I know what interest rate, because it's what interest I was paying to the bank that I'm no longer paying. And everybody, like on a 50-year mortgage, loses their mind.
Yeah.
Because they go, think about how much interest you're paying in 50 years. What they're not considering is, let's just say, for numbers' sake, you could earn 5% or pay 5%. And that was pretty stable that you could earn 5%. I know that's not as guaranteed as you know it's guaranteed that you're paying 5%. Whether you did a 50-year, 30-year, 15-year, or paid cash, it's all the same interest cost. Here's why. You're always paying interest. Whether you pay cash, the interest you pay is called opportunity cost. You lose the right to earn interest on that money. And even though it's a small amount that first year, that small amount gets to grow for 49 more years with that lower payment.
Yeah,
if
just
you
like
save the difference.
Gotcha.
Right?
Just like it would have grown if you were.
Again, we know the interest we pay when we borrow. That's so easy to see.
Yeah.
But that's a part of the story that only speaks to the saver. The investor says, what's my money worth? What is my money worth? And here's the thing. Billionaires have a good cost of money. They have a higher cost of money. Our cost of money is the highest interest rate that we can earn sustainably for long periods of time. So where this has got really, really risky for people is between like 2002 and 2008, we had a huge spike in real estate. Real estate values really increased during that time.
Yeah.
And what people got really big on was refinancing with that equity. And then they would take that equity and they would invest it. And they might put that in the stock market because they're like, look, the stock market has earned 10% since 2000 BC. Whatever they always like, that's the number that people use a lot of times. They bought against their home, which will increase the payment.
Yeah.
They have a higher payment. And now they put their money into something that does not cash flow. So what they've created is negative cash flow for potential wealth.
Oh, it doesn't cash flow because even though it may increase with interest,
it's negative because you just pulled money out. Let's say you pulled out $100,000. That's not $100,000 free and clear.
But you're not seeing that money in your bank account every time the stock market
loan,
increases.
and if you put that $100,000 into, let's say, just the stock market, right?
Yeah.
Unless you're putting it into utility stocks individually that kick off dividends.
Oh, okay.
If you're putting in tech stocks don't pay dividends, they reinvest.
Yeah.
So it's all based upon appreciation. Well, what happens if you can't afford that loan because all of a sudden 2008 happens, and this is where people got in a lot of trouble, is they used, there was these loans. There was a loan that used to be called an option arm. Okay. An arm is an adjustable rate mortgage. So there's fixed mortgages, which is, I know what my interest rate is, the life of the loan.
Yeah, it's going to always be that way.
And there's adjustable loans, which it could go up as interest rates go up. And guess what? Interest rates started to increase. Now the option arm gave you 4 options. Okay. The first option was interest only. Now, one of the advantages of an interest only loan is when I pay it down, it lowers my payment. That's great.
Yeah.
But it's very rare to get a full term interest only, like 30-year. They're usually like 10 years and then it's variable again.
Oh, okay.
So what if you have a really low interest rate environment and then all of a sudden in 2002
it hops,
or 2022, interest rates start increasing, your payment starts going up. That could be, again, a negative cash flow.
Yeah, geez.
The second is you could pay it like a 15-year if you wanted, right? But it's still, it's just still variable. You could pay it like a 30-year, or this is the dangerous one. It's called a negative amortization. You pay less than the interest rate and they add it to your balance. And people were doing this loan, so their cash flow was fine until the interest rates started to increase, and then the loan had to recast. Because what happens is,
because eventually,
let's say that you have $1 million home,
again,
just for the sake of this, but you're not paying enough on it, so now it's $1,100,000 a few years later. But the value of the home decreased because in 2008,
we had the crash.
We had a major crash, right? It could have been like a 20% or more decrease. Now they're saying, hey, you have too much risk, so we need you to pay the difference.
Oh, geez. As like a lump sum or what?
Like it depends, or that you need to refinance, or like there's a certain parameters where now you had to make bigger payments instead of a recast.
Jeez.
And that big payment could, again, be a higher negative impact on you. So,
because you didn't plan for it.
Right. So, again, you've got to know your cost of money. Now, for someone with a 30% credit card, that's your cost of money. Because every dollar you spend that doesn't pay down that 30% is costing you $1.30 because of the interest.
So regardless, investing, savings, any of paying off your mortgage, none of that will ever compare to just paying off your credit card.
Well, I mean, you'd have to have like some credit cards have those introductory rates, right?
Yeah.
Might be 0% for 6 months, or a balance transfer where you can take one credit card and roll it over. And there's some that might even be longer than that, but that's a pretty common term. There might be better interest rate credit cards because you're not getting points, and you're not, because like Amex could be really high, but you get all these points for travel and stuff like that.
Yeah.
It's, hey, if you're paying that off, that's amazing. I have this, Chase Business Reserve. I mean, I just booked first class tickets to Hawaii and back for me and my family off of several months spending. So that was awesome.
Oh, just on points and stuff.
Because the points, I mean, I was getting first class for like 50,000 points, 55,000 points. That's awesome. But if I don't pay that off, that 30% is much more expensive than tickets.
Yeah.
Right. So it comes down to billionaires have a very high cost of money. They can deploy capital and get a very good return. But the first return they look for is, how can I reduce tax? How can I get better interest rates? Right. How can I become a better investor so I could get more? And here's the thing. A lot of them invest in private capital.
So they're not in the public markets.
Right. And private capital, overall might be a 2 times return over a public market. Public market's just like an index fund or an individual public stock, but there's a much higher rate of loss in private capital because, it's not easily liquid. It's like when I have public, I can just go and say, I want to trade this stock. I want to sell it. I go to, an app. I could make a phone. Like, it's so easy to sell. Private capital is a less liquid market.
Yeah.
So you're dealing with more sophistication and more risk and things like that. But the numbers are astronomical for good private capital versus public investments. Yeah. It's just that, again, like, a bad fund in a year might get 7% and a good fund might get 9%. There's not a huge difference overall. But in private capital, you might get 0% and lose everything, or you might have got 24%. So it's a big variance. It's a big difference there.
How can I implement some of the same stuff without, having millions or billions of dollars for a, command center?
So automate so that you have savings.
Okay. So instead of focusing on budgeting.
Right. Yeah. Well, that's going to be some gold, some silver, cash value, or maybe a money market, something like that. Right. And 2, you can still look to be efficient.
And what do you mean by automate savings?
You just have a sweep account. So every time you make a deposit, it goes to 2 accounts instead of 1.
Gotcha. So every time my paycheck comes in, I don't have to think about it.
To your checking and 10% to your wealth capture.
Okay. Gotcha.
Right.
And like a lot of the
off the top.
Yeah. A lot of the the fintech banks, like the online only banks, they do this as part of their services.
Yep. Absolutely.
Okay.
There's a lot of them out there.
Cool.
So then second, look to be more efficient. So that could be, reallocation. So reallocation is take anything that has a high interest rate and pay that off before you start investing in a lower interest rate.
Gotcha.
That's pretty simple.
Okay.
You might even just renegotiate interest rates.
So you're saying like maybe do like a balance transfer from a credit card that has a promotion offer to pay down a high one?
Yeah. I mean, I wouldn't get in the game of balance transfer all the time.
Oh,
it could be, it could have impacts on your credit because you're setting up new accounts and inquiries.
Okay.
Doing it once, probably fine, but you could refinance, that would be one thing you could do. People have a paid off car. Refinance that and pay off a credit card. That's a car loan is great for your credit. You pay it on time.
So you're saying you have a car that you aren't making payments on, and then you get a loan off that car.
Yep. You refinance it.
Okay.
And get a loan.
Which is different than a title loan, because I think title loans are usually like these 300% things.
Yeah, like if you have
like
good credit, you have to have good credit to do
like a credit union or something that gives you a title or a loan on the car.
And then the third thing is invest in yourself. Like you've got to create a way to make more money, because if you're going to live off of $30,000 a year, there's not a lot of options. Budgeting is the only thing. There's no way to get kind of a command center. Now, Matt, one of my partners, he's built an entire platform to create this command center for someone that's just starting out. It's because of AI and it's through technology, X1 Wealth Lab, right? Just x1wealth.com. So that's a great tool for people. So you can all of a sudden have that command center. You can see what your numbers are. You can make better decisions. You can create priorities. You can analyze where to save, all those kind of things so that you have the power. Where before, only really family offices could do that. I mean, my firm, what we've built is a system that instead of having, hundreds and hundreds of millions of dollars to work with a family office, we've built a command center and a black box technology that says every time someone uploads a document, it reanalyzes, recasts, and says, what are the decisions? We have accountants and attorneys all within the system so that we can do all of that at a fraction of the price, because I feel like it shouldn't just be for the ultra high net worth. That's part of what I always look at is like, what's ultra high net worth that anyone can do? Now, there's plenty of stuff that not anyone can do. There's these crazy dynasty trusts. There might be stuff that they do overseas. There might be a number of things with crazy, tax attorneys that can do all sorts of things with collectibles and, just absurd tax strategies that's not going to be available to everyone. But knowing what's going on and thinking like an investor to say, how can I grow this and focus on cash flow first so you're financially independent. And then when you're financially independent, you can have a little bit of speculation with something that would be, a high potential return like private capital, but it wouldn't destroy your family, your lifestyle, or all your savings because too many people take risk with money they can't afford to lose.
Yeah. So basically you say, okay, if I lost this $10,000, it wouldn't impact me in any way. And that's an okay time for me to invest it in something.
Right. We've got to create financial intelligence because we've been told it's too complicated. Just trust everybody else.
Yeah.
And Wall Street's not someone I really trust. They always win. They say it takes money to make money. It takes your money for them to make money.
Yeah.
They say high risk equals high return. You take the risk, you get the return. They tell you you're in it for the long haul. Well, they create cash flow all the way through. So it's like a completely different system.
Yeah.
So how can you increase your cost of money? That's a good question. How do you become a better investor? That's the key. If you could become a better investor, well, I always think that if you can invest in your skills so that you can make more money, then you get really good at keeping the money that you make without having a budget. That's the command center type of philosophy. Then you learn to grow your money. And that begins with focus first. Like diversification is a great preservation strategy. If you want to have sustainable wealth, diversification is instrumental, but too many people diversify or prematurely diversify. They diversify, they don't even know what the results are going to be. They're divorced from it. They have no cash flow. They don't know why it's going to work, when it's going to work, how they're going to benefit from it. And that is where I call it speculation and gambling more than investing. Most people say they're investing, or they say they're saving when they're just speculating, or they say they're investing when they're just gambling. And so this comes down to information and team and understanding what's going on and watching things like this. So, I had someone at dinner last night say, hey, what do you think about tax liens? I'm like, they're legitimate. There's people that make a lot of money doing it. It's competitive. Is it what you want to spend your time doing? Are you going to, you basically, taxes are owed on a property, you buy out the tax lien, and then eventually when the taxes are paid, you get it. And if the taxes aren't paid, you can end up with the property. So yeah, those are, there's plenty of books and strategies and ideas around that. But to me, it comes down to, well, it depends on your investor DNA. And for me, I work with so many entrepreneurs that the first thing I want to say is, let's build a business that you don't grow to hate. Let's build a business that you can operate in or not and still have it work. So you build infrastructure, you build team, you learn hiring, you grow your business acumen. You don't exhaust yourself.
Yeah.
Too many people in business, they hustle so much and they grind so much that they get tired and they want to sell it.
Yeah.
But I'm like, you don't have to, like, if you have no imagination or you have no idea of what to do, maybe an index fund is your best option. But if you have a way that you know how to create value, you can invest in that. And then you learn how to turn your business wealth into personal wealth, and for me, that's why I have a decent amount of cash value. But I'm always looking at, like, how can I have this business become more efficient, more effective, reach more people, add more value, and become more profitable because of that. And too many people shortchange that because they're siphoning the money off into things and putting it in places they don't know or understand, because they think that retirement plan is going to be the end all be all and holy grail, when it's not. I mean, Tony Robbins wrote this book called The Holy Grail of Investing. And it makes a great case of, like, private capital has far outperformed public markets. And yet most people only put their money in public markets. And unfortunately, there's companies like Edward Jones that have 10 times the presence in rural communities than it does in metropolitan, because what they do, my buddy Greg Ayler wrote this book called Fire Your Financial Advisor, where he's like, hey, we've done the numbers, and they've got managed funds, and they're charging a 1% fee, and it's up to 5% sometimes, that people are just losing because they don't know any better. And so if you're not going to,
because it's the only option that they are aware of.
If you don't take responsibility and say, I'm going to figure this out, I would say raise the flag and surrender and say, I'm just going to put my money in the index fund and pay off my mortgage. Just know that inflation might be a major issue, and you didn't train yourself to create cash flow, which will be an issue when you get to retirement. My entire argument here is just create the life you don't want to retire from, right? I mean, I get it. There's a lot of work out there. Like, my dad was a coal miner. That's something you want to retire from, because that is really grueling work.
You don't want to do it your whole life.
But we're in a world right now where there's so much that you can create that you can stay for long periods of time. My friend Myron Golden, he's in his 60s and just doing so well with business and helping so many people out. And he has so much wisdom that he shares, and he's taught me so much. And it's like, I don't want him to retire And what would he do if he retired?
Yeah.
You know, he's still taking trips and doing the things. Just enjoy life along the way. Don't only focus on one day, someday. Invest in yourself, focus on your quality of life, and then just, you know, and when you enjoy your life, you're going to have more energy. Find the things that interest you, that you're willing to invest in, that you're willing to learn about, instead of doing things you hate, just trading time for money, and then, you know, feeling like you have to forfeit into an index fund.
Well, it's interesting because it's like going along the budgeting thing. I feel like our focus is always budgeting money, when really it sounds like you're saying like it'd be better to budget life, right? Like get rid of the things that you don't enjoy and that you don't need. And
it doesn't mean that we won't do things that we don't enjoy along the way to gain the skill, but don't get addicted to the things that you don't enjoy and find resentment and frustration and exhaustion.
Yeah. So it's like, if, you know, my most frustrating thing is, you know, cleaning my car. It's like, okay, can I get to a point where I can hire someone to do that, or get a service that does it? Or,
I mean, for some people that might just be starting a business and doing it all on their own, you could have a virtual assistant help. You can have an independent contractor. You can find ways to get there. And then as you have more capital, you just have to be willing to invest the money into you. And then you have to be willing to invest the money into a team. And the hard thing about that is it's really easy to see, if I take money and I put it into a 401k, I can see that balance.
Yeah, you can see the growth.
If I take that money and I hire a team member, it might take longer before I see the increased cash flow, and longer before I see the payoff.
Yeah, or even longer to see your own increased productivity because someone else is handling stuff.
And sometimes it's easier to let other people make mistakes, like the fund manager, than for us to make mistakes and have to learn it. It's a little bit more painful, but it's a lot more powerful at the same time.
Yeah.
So, yeah, I guess, you know, not everybody could do it my way, because I would say that if you could be an entrepreneur, that would be ideal. If you can't, be an intrapreneur. Find ways that you can have upside in the job that you have, that it's not just time for money and pure salary, but everyone that works in my organization, they have certain things that when they do, they can make more money. As we boost the bottom line, they benefit. As we increase the value, they benefit, and we all win together. And, you know, I know there's a lot of people out there watching that are like, oh, these stingy business owners, they're getting so wealthy on everybody else's back. It's like, well, do something different then, or find the one that's not.
Yeah.
You know, I've got good friends that, you know, have big businesses, and the people that are with them are just growing, and I'm watching them evolve and develop and make more money. That, like, we all win together is the best process and plan.
Yeah. And the reality is, how many millionaires have come from billionaires? So many. Yeah.
I mean, I can you imagine how many millionaires Elon's created?
Yeah.
Right. Yeah. People love to hate on him. You know, I like him. I mean, Starlink right here that I'm using at this cabin is pretty amazing. Yeah. You know, and who knows how many other things my life has benefited from with the things that he's advanced. And, you know, it's interesting because vision is the rarest commodity, you know, where labor has a lot of limitations. Okay. Because vision is the container in which we create value, and dollars follow value. So if you want to make more money, you've got to ask yourself, how can I create more value? How can I be more valuable?
Yeah. Not how you can do less.
And you got to be in the right model where you are rewarded for your value, right? There's places that you work that the more value you create, they're not paying you anymore. They're not doing any more for you.
Take advantage of you more.
Very infuriating. It's very frustrating, but you can't say that that's how everyone is. It's just like, you've got to say, is it worth it?
Yeah.
You know, what are you giving up for that security, for that benefit, for that golden handcuff, for that match, whatever it is it worth it? And what else could you do? I mean, look, I started washing cars when I was 15 years old. Garrett Gunderson's Car Care. What just uniquely named.
What a great name.
But it taught me about income statements, right? Profit and loss, income versus expense. It taught me about balance sheets, right? Assets versus liabilities. It taught me about customer service. It taught me about, I don't want to be doing this blue collar work. It's no fun long term, but it was great to learn the basics of business. And then I took that money that I made from that and I invested into financial programs when I was still at university. And that helped me to learn a lot about economics, and it helped me learn what a family office was. It helped me to get into these rooms where I saw what ultra high net worth people were doing and start to ask, how could I apply this to everybody else? And how can I help entrepreneurs? Because they have a more complicated tax situation. They have a more complicated insurance situation with business owner policies. They have a lot more stuff that, asset protection, corporate structure. There's a lot of moving pieces. And I like helping them with it because that saves them money. I don't have to have them invest in things that they know nothing about. I don't care whether they invest in those things. I just want to help them be more informed about it. I'm not trying to make money on that. I get paid for consulting fees. I get paid for building a family office for them and building a command center and not living this budgetary lifestyle, which is all about less, but a productive lifestyle, which is all about how do I serve more, solve bigger problems, and help more people out. It's a game I want to play. It's a lot of fun. It's how I've gone and done things.